Alright, so in this video I want to talk about an earnings trade I did on Home Depot. I used the put credit spread strategy. So let me explain. So February 24th, Monday, before the earnings of Home Depot was going to be announced. Home Depot was going to announce earnings February 25th before market open. So February 24th before market closing, I placed my put credit spread. So Home Depot during the day on Monday was trading between 239 and 242. 238 and 242 was trading in that range. So based on expected move, I sold a put credit spread at a 225 strike, short strike, expiring March 27th. So about 30 days out. So how did I pick the 225 strike? Basically, I looked at expected move. And how do I calculate expected move? Here, I'll show you. If I look up the option chain of Home Depot, I'm going to choose vertical, which is a credit spread or a debit spread. And then I'm going to choose the expiration that I want. In this case, it was March 27. And I'm just going to click anywhere here just to update the order entry window. And then I'm going to look at the value of the at the money put and the at the money call. So the at the money put is 235, right? Because the stock's trading 235. I can see that it's trading that it's worth $7.30, as you can see here. And if I look at the call at the same time, it's worth $6.65. So 7 plus 7 is about 14. Let's round it to 15. So expected move is 15. So if the stock is trading at 235, I'm going to pick a strike of 15 points lower. So in this case, it would be 220. But when I placed my trade on Monday, Home Depot was trading at 240, and it was also around 15 points of expected move. So that's why I picked a 225 short strike. So I sold the 225 put option. I bought the 220 put option expiring March 27. So when I do that, it gives me a credit. I collected a credit of 95 cents. My risk is the difference between the spread. So 225 minus 220 is 5, and then $5 minus the credit that I already received. So $5 minus 95 cents is $4.05. So $4.05 is the max that I could lose in this trade. But that only occurs if by March 27, Home Depot is trading below 220. So if you look at the chart here, Home Depot is trading around 240s. So for me to win, I just need Home Depot to stay above 225 come March 27. Now the idea of this trade is when earnings is announced, the value of the premiums drop. There's a volatility crush. So my idea is to close the trade the next day for less than what I collected because there's a volatility crush. Now the next day, Home Depot went up. It went from 240 to 245. So it started the day at 245. So that did two things for me. First of all, the stock went in the direction that I wanted. It went further from my short strike of 225. And because earnings was released, there was a volatility crush. So these two incidents allowed me to close the same put spread that I opened on Monday. I was able to close it on Tuesday for 47 cents. So you can see here February 24th, 2 p.m., 95 cents. February 25th, 9:33 a.m. So didn't waste time in the morning. Closed it for 47 cents. So the difference here is my profit. So it's about 50% profit of my 95-cent premium collected in one day as opposed to waiting until March 27th. Now I'm pretty glad I closed the trade early because as you can see, the following day and the same day actually, it dropped even more. It dropped to 238 and today even worse. I'm pretty happy I closed it right away and didn't hold on to it. Now what I like about this trade is that it gives me room to be wrong. Even if I'm wrong, I could still make a profit from this trade because I could be wrong by about 15 points and I could still win because my short strike is 225. So even after earnings, if Home Depot dropped below 225, I still have time. I still have until March 27. I don't have to do anything. I just have to wait. Maybe Home Depot will come back up eventually. So the only difference is if Home Depot goes in the direction that I want, which is up, I can close the trade faster. If it doesn't go in the direction that I want, if it goes against me, then I have to hold on to the trade a bit longer. Maybe I'll have to wait till expiration. So that's why I like this trade. I can make money in several different ways. It could go up, it could stay put, and it could even drop a little bit, and I could still make that same profit. My max profit though is 95 cents per contract. I did one contract, and since one contract is 100 shares, so that's $95. My max profit is $95, but that's achieved at expiration. Or if I close the trade early, then I keep the difference. So that's about a $48 difference that I keep in one day. So it's $48 divided by a capital risked of $405. So it's a pretty good return on capital in one day. And I could have done more than one contract, but obviously it depends on my risk tolerance and how much capital I have. Right now with the market dropping, things are getting tight and I actually have negative equity in my margin account because I've got a bunch of put spreads on the SPY that are getting in the money. So I've got the short strike is the price at which I need the SPY to stay above come expiration. So I still have time because the expirations are 30 days away almost, but you could see that this one is in the money. So the SPY is trading below 328, 328, 326, 325, 320, and the good ones that I had are getting closer also. 308, 305, 300, 295, 290. They all have different expirations, but who knows how long this drop is going to continue, and then they could all be in trouble. But I have to manage them either by selling a call spread or rolling the put spread forward, so extending the timeline on the trade, giving the SPY enough time to come back up. But in this video, I want to talk about the Home Depot earnings trade, and I use this site called Earning Stats to help me look at probabilities. And before I placed the trade on Home Depot, I saw that 72% of the time in the last 69 earnings, 72% of the time it went up, so that's good. 84% of the time it stayed within expected move. So even if it went down, it stayed within expected move, and my strike was further than expected move, so I was safe in that regards as well. And if you look at the graph here, you could see that you see more green than you see red. It goes up after earnings more often, and even when it goes down, it doesn't go that much. So my short strike that I had at 225 when Home Depot was trading at 240 is relatively safe, especially that I still give myself an extra 30 days. This year considers the same week expiration, so a February 28 expiration, for example, in this case, but I took a March 27 expiration, so I even went further than expected move. February 28 expiration is probably even less than 15 points. February 28 expected move is most likely less than 15 points. Look at February 28, 235, you could see that we've got 3 points and about, let's say, so 6 points. So expected move on February 28 expiration was about 6 points. I went 15 points away just to be even safer, but because I went with a March 27 expiration. So there's many ways to play earnings, but I'm just sharing the way right now currently I like to play it. I find this safer, less stressful, and it's enough that I have to deal with negative equity in my margin account. All right, so if you have any questions regarding this earnings trade or any other earnings trade, don't hesitate to leave it in the comments section below. Please like, share the video, and subscribe to the channel. I like to talk anything personal finance, investments, money management, income taxes. And if you can open an account with Questrade to trade on the stock market, use my referral code in the description below the video to get up to $250 back. Thanks for watching.